Welcome to the history of the HECM. What we're going to do today is we're going to break down the evolution of reverse mortgages and demonstrate the key differences between the old reverse mortgage and the new reverse mortgage. My name is Jared Gibbons, and I'm the Executive Vice President of Reverse Training and Development here for Fairway Independent Mortgage Corporation. The home equity conversion mortgage, or HECM as we like to call it, is one of the most well-developed loan products in the mortgage industry. Since 1961, reverse mortgages have been through many developmental milestones to make a safe financial tool that's available today. The product has seen rapid growth, expansion of additional innovative loan products, improvement of practices, increased consumer awareness, and a redefining of the options that are available to seniors. So, what we're going to do is we're going to take a moment as we look back at the major turning points and milestones in the history of reverse mortgages. The concept of reverse mortgages was first practically implemented in the United States in 1961 by Nelson Haynes, who was a loan officer at Deering Savings and Loan in Portland, Maine. This loan was made privately to a widow named Nellie Young to help her remain in her home despite losing income after her husband's death. In 1983, the U.S. Senate Special Committee on Aging convened to examine the potential of reverse mortgages as a tool to assist senior citizens financially. This hearing was important because it brought national legislative attention and legitimacy to reverse mortgages, which paved the way for future policy development. The Housing and Community Development Act of 1987 authorized the creation of the Home Equity Conversion Mortgage, or HECM, pilot program under the oversight of the Federal Housing Administration, FHA, and it's administered by the U.S. Department of Housing and Urban Development, otherwise known as HUD. In 1988, a significant development in the history of reverse mortgages occurred when President Ronald Reagan signed the Housing and Community Development Act into law. This legislation authorized the Federal Housing Administration, or FHA, to ensure that reverse mortgages were leading to the creation of the Home Equity Conversion Mortgage, or HECM program. The following year, in 1989, the first FHA-insured HECM was issued to Marjorie Mason of Fairway, Kansas, by James B. Nutter and Company. This event marked the beginning of federally insured reverse mortgages in the United States, providing senior homeowners with a means to convert part of their home equity into cash while remaining in their homes. The HECM is the standardized federally insured reverse mortgage product that remains the most common reverse mortgage in use today. In 1998, the HECM program was officially established as a permanent offering through the HUD Appropriations Act. This transition from a pilot to a permanent program included the implementation of safeguards, such as full disclosure of fees, which protects borrowers from unnecessary charges. In 2008, the Department of Housing and Urban Development, or HUD, made two technical changes to the HECM program. One, the date for determining the maximum claim amount was moved from the underwriter's receipt of the appraisal report to the date of closing, providing a more verifiable and identifiable date. Two, clarifications were made regarding the eligibility of properties with restrictive clauses, ensuring that such properties meet specific criteria to qualify for HECM insurance. In 2013, HUD implemented several changes aimed at strengthening the HECM program. Financial assessments introduced requirements for lenders to conduct financial assessments of prospective borrowers to ensure that they could meet tax and insurance obligations. Initial disbursement limits placed limits on the amount of funds that could be dispersed to borrowers during the first year of the loan to preserve equity and extend the longevity of the funds. Mortgage insurance premiums, or MIP, adjusted MIP rates to better reflect the risk and ensure the program's sustainability. In 2017, further measures were introduced to bolster the HECM program. Initial and annual MIP rates standardize the initial MIP rate to 2% of the maximum claim amount and set annual MIP rate at 0.5% of the outstanding mortgage balance. Revised principal limit factors reduce the amount of equity that could be withdrawn, aiming to prolong the fund's solvency. From 2021 onward, several updates have been made to modernize and adapt the HECM program. In 2021, HUD removed the London Interbank Offered Rate, or LIBOR, as an approved index for adjustable rate HECMs and approved the Constant Maturity Treasury Rate, or CMT, as its replacement, which is determined by the U.S. Treasury and the Federal Reserve. COVID-19 relief measures implemented temporary extensions and forbearance options for borrowers affected by the COVID-19 pandemic to provide financial relief during unprecedented times. The maximum claim amount has seen periodic increases to reflect changes in housing prices. Effective January 1st, 2025, the Federal Housing Administration, or FHA, has raised the HECM maximum claim amount to $1,209,750, which is up from the 2024 maximum claim amount of $1,149 or $1,149,825. This increase allows homeowners with higher valued properties to access more of their home equity through this program. And in 2022, HUD updated policies regarding non-borrowing spouses, removing the firm 90-day deadline for establishing marketable title or the legal right to remain in the property, thereby providing more flexibility. These developments reflect HUD's ongoing efforts to enhance the HECM program's stability, its adaptability, and responsiveness to both market conditions and borrower needs. Now remember, a home equity conversion mortgage, or HECM, is a type of reverse mortgage insured by the Federal Housing Administration, FHA. It also allows homeowners aged 62 and older to convert part of their home equity into cash, providing financial flexibility during retirement. Eligibility includes that the homeowners must be at least 62 years old, the home must be the primary residence, borrowers must have sufficient home equity or funds, and borrowers are required to complete HUD-approved counseling before applying. Borrowers can receive funds in several ways: a lump sum, which is a single upfront payment; monthly payments, which are fixed monthly payments either for a set term or for as long as you remain in the home; a growing line of credit, which gives flexible access to money as needed. And then there's the combination, or any combination, of those three: the lump sum, monthly payments, and a line of credit. When looking at loan repayment, we'd like you to note that unlike traditional mortgages, HECM loans do not require monthly payments. The loan balance, which includes borrowed principal plus accrued interest and fees, becomes due and payable when the borrower permanently moves out, the borrower sells the home, or the borrower passes away. Typically, the loan is repaid by selling the home. Any remaining equity after repayment goes to the homeowner or their heirs. The amount one can borrow depends on their age, and older borrowers typically qualify for larger amounts, the home value, which the appraised value or the FHA limit is used, whichever one is lower, the interest rate, current market interest rates affect the loan amount, and financial assessment. Income, assets, and credit history are used to determine if escrow for taxes and insurance is required. In order to meet ongoing obligations, borrowers must continue paying property taxes and homeowners insurance. They must maintain the home in good condition and remain living in the home as their primary residence. HECM loans have several upfront and ongoing costs, including upfront and annual FHA mortgage insurance premium, or MIP, upfront origination fees, upfront closing costs, which include appraisal fees, title insurance, and so forth, and also interest accruing monthly on the loan balance. The key benefits of the HECM include no monthly mortgage payments that are required, non-taxable proceeds, and FHA insured protection, which the homeowner or their heirs will not owe more than the home's value upon sale. The home equity conversion mortgage, or HECM, program is undergoing significant changes in 2025, which is impacting its future landscape. Key developments include increased lending limits. Now, as we mentioned earlier, effective January 1st, 2025, the Federal Housing Administration, or FHA, has raised the HECM maximum claim amount to $1,209,750. Now, analysts anticipate that home equity loan interest rates will remain steady, hovering around 8.3% to 8.5% as of April 2025. This stability is influenced by the Federal Reserve's recent decisions and prevailing economic conditions. The reverse mortgage market is attracting attention from investors with expectations of new opportunities emerging. Additionally, proprietary reverse mortgages are gaining traction, offering alternatives for homeowners with high value properties that exceed FHA limits. The Department of Housing and Urban Development, or HUD, continues to update policies governing the HECM program, aiming to enhance its administration and alignment with broader housing finance objectives. These developments suggest a dynamic future for the HECM program with expanded opportunities for eligible homeowners and ongoing adjustments to meet evolving market and policy landscapes. So in conclusion, HECM loans are a useful financial tool to access home equity while aging in place. However, careful consideration, financial counseling, and consultation with a highly trained fairway reverse mortgage specialist are strongly recommended before proceeding. We thank you for participating today and, of course, welcome any questions, comments that you may have. Please don't hesitate to reach out to us at reverseevents@fairwaymc.com. We hope that you have a wonderful rest of your day, and we look forward to seeing you next time. Thank you.